Are you tired of watching your hard-earned money wither away in a savings account, barely keeping up with inflation? Do you dream of building wealth, securing your future, and achieving financial freedom? But the world of investing seems like a dangerous roller coaster, full of confusing terms, hidden risks, and the constant threat of losing everything. You're bombarded with hot tips and complex strategies from self-proclaimed gurus, each promising instant riches. It feels like everyone is trying to take your money. This is Finance 101, simplifying finance one concept at a time. And in this video, we'll cut through the noise and reveal the truth about investing. We will show the basic building blocks of investing. We're here to guide you up the investment risk ladder step by step. Forget advanced math and complex strategies. We'll focus on understanding the fundamentals. Whether you're starting with $50 or $5,000, this video will give you the knowledge and confidence to begin investing today. We get it. We were once in your shoes, overwhelmed and intimidated by the financial world. We made mistakes, took bad advice, and learned some hard lessons along the way. But we discovered that successful investing isn't about luck or secret formulas. It's about understanding the playing field, making informed decisions, and staying disciplined. We are no Wall Street experts or financial advisors. We are just folks who want to share what we've learned to help you achieve your financial dreams. Let's climb the investment risk ladder, starting with the safest and most basic asset class, cash. This is your savings account. It's safe, easy to understand, and guarantees your capital back. But the interest barely beats inflation. Think of it as parking your money safely, but it's not going to grow much. Next up are certificates of deposit, CDs. These are less liquid because your money is locked up for a time, but they usually offer higher interest rates than savings accounts. Bonds. A bond is like lending money to a company or government. They pay you a fixed interest rate in return. It's like being a landlord, but instead of renting out an apartment, you're renting out your money. But before we climb higher, let's address a common fear: losing money. That's where diversification comes in. Diversification means spreading your money across different types of investments. Don't put all your eggs in one basket. If one investment goes down, others might go up, balancing out your overall risk. Think of it like a sports team. You need a mix of players with different skills to win. Mutual funds. A mutual fund is a pool of money from many investors, managed by a professional. It allows you to own pieces of many different companies with a relatively small investment. It's like ordering a pizza with friends. Everyone chips in and you all get a slice. Some mutual funds, called passive funds, simply track a market index like the S&P 500. Others are actively managed, with professionals trying to beat the market, but they typically charge higher fees. Exchange-traded funds, ETFs. ETFs are similar to mutual funds, but they trade like stocks throughout the day. Think of them as a hybrid between a stock and a mutual fund. You get diversification and flexibility. Stocks. When you buy a stock, you're buying a tiny piece of ownership in a company. You can make money if the share price goes up or if the company pays dividends. It's like buying a share of a business. If the business does well, you profit. Now let's talk about the villains of the investing world: hot tips and unreliable sources. These are the people who promise you instant riches with little to no effort. They might be trying to sell you something, or they might just be clueless. But remember, if it sounds too good to be true, it probably is. At the top of the risk ladder, we have alternative investments like real estate, commodities, hedge funds, and private equity. These can offer high potential returns, but they also come with significant risks and are often illiquid. Think of them as the advanced classes in investing. Only take them when you're ready. Some investments, such as hedge funds, are restricted to wealthy investors. Investing is a long-term game. Don't expect to get rich overnight. There will be ups and downs, but the key is to stay disciplined and focused on your goals. Just as different types of weather call for different clothes, various economic conditions tend to favour different investments. The most difficult time for any investor is watching a market enter a period of turmoil. So how do you get started without losing your shirt? Here's a simple, three-step approach to start your investment journey. Begin with the basics. Start with mutual funds or ETFs that track broad market indexes. Keep costs low. Every dollar you pay in fees is a dollar that's not growing in your account. Diversify. Gradually, as you get more comfortable, you might add different types of investments. Remember Warren Buffett's advice. Most people would do well with just two funds, one tracking the S&P 500 and one tracking US bonds. Investing doesn't have to be scary or complicated. By understanding the basics, diversifying your portfolio and avoiding the villains, you can build wealth and achieve your financial dreams. Take control of your financial future. Start small, stay informed, and never stop learning. If you found value in this video and wish to deepen your understanding of financial principles, we encourage you to subscribe to our newsletter. Each day, we will deliver concise financial insights directly to your inbox, designed to be easily digestible and immediately applicable. Subscribers will also receive curated video recommendations supporting consistent and continuous learning in finance. Simply click the link in the description below to subscribe and further your financial education. Thank you for watching. Stay informed, invest wisely, and we look forward to seeing you in the next video.